Have you ever wondered why some businesses seem to thrive during uncertainty while others scramble to survive? It's not luck, it's not size, it's something called a captive insurance company. And today, you're about to learn how it could be the smartest financial move you've never heard of. Imagine setting aside pre tax dollars to protect your business from risks that traditional insurance ignores, all while building your own private safety net legally. We are joined by Van Carlson from SRA 831B, an expert in helping businesses leverage Section 831B of the tax code to take control of their risk, their reserves, and their future. If you're a business owner looking to play the long game, stay with us. This might just change the way you look at risk, insurance, and taxes forever. Van, welcome to the show.
Yeah, thank you, Mike. That was a great intro. I appreciate your insight already. So
yeah,
awesome.
No, I'm super excited to kind of talk about this topic because it's something that I would say a lot of business owners don't know about. And then some business owners that have heard of it, sometimes they start to get a little leery of it just because they type in captive online and things scare them right away. So I want to kind of talk about the process of a captive, what it means, what they are, some of the risks, what that risk might look like, if there is risk, where we kind of talk about that. So just to get started, kind of what is, generally stating, a captive insurance company and how do they work? What's the intention of them?
Yeah, so captive insurance companies, the concept's been around for a very long time. It's self-insuring risk. And a lot of times it has to do with traditional insurances when we talk about work comp, general liability, and all those things, down to we call enterprise risk management, which is what you kind of alluded to about insurance companies just simply not wanting to cover those types of things. The best example, obviously, we would give is COVID recently, right? I mean, the government had to step in and do what they did because insurance companies weren't going to cover it under business interruption. They really couldn't afford to. We couldn't afford them to do that because our insurance premiums would be so astronomical. We'd be hard pressed to be in business. But so that's kind of where that's really what it comes down to, is recognizing self-insuring risk that you're retaining. And this becomes a funding issue, right? Where it's an unfunded liability now on your books. Now you typically if you're going to buy an insurance policy to insure for your building, for example, for fire, theft, vandalism, wind, hail, and all that, you funded that risk by buying a policy by giving them premium, and you're transferring that risk to them. Then there's other risks you just retain on your books, and it comes down to a simple concept, Mike. If you have an unfunded liability, how do you want to fund it? Do you want to ignore it? Just keep doing what you're doing, and you just hope to God it's never going to happen. And if it does happen, you're just going to use after-tax money, operating capital, or hopefully you got enough room left on your line of credit to use that if you have to, right? That's the backstop of emergency and that kind. Or the other option is using pre-tax dollars to handle that unfunded liability. And the whole idea of that, and that's really where the 831B comes in. So that 831B came into existence in 1986, Tax Reform Act. Very similar to one marketplace we're in today. Back in the 80s, you had a lot of liability issues going on. Companies were having a hard time making money, and they were finding ways to get off risk. Eerily similar to where we're at today with traditional markets. And so I would, in fact, being in risk management for almost 30 years now, I would never think to predict the market we're in today. And the Treasury, I know, was just recently talking about the status of insurance industry in the United States. And it's a concern. It's a big concern because it can stifle growth. You need insurance. You need good insurance policies. You need good insurance companies and all those types of things. And one way that they're doing to be able to manage their risk is they're putting more responsibility back on the insured. So you're seeing higher deductibles. You're seeing replacements going away. You're seeing a bigger co-insurance deductible, especially when it comes to wind, hail. Coastal properties are having a heck of a lot of stress on it. And then you're even seeing it in commercial auto now, which, I would say auto insurance for a long time has been very stable premium wise, but we're seeing huge spikes around the country with that right now. And then you're limited to even fire protections. I know due to LA fires right now, there's going to be a huge disruption, unfortunately, going forward with people in mountain region areas, brush areas. So and one of the ways that they're going to do that, they're just going to put the burden more and more on you as the insured. And that being said, it comes down to what we said earlier about the unfunded liabilities and how do you want to fund it. So one of the big ones that we see right now is we call deductible reimbursement, where we just simply have clients taking on much substantially higher deductibles than they were 5 years ago.
Yeah.
And of course, if anything was to happen, where are you gonna get that 50, 100, 250? I mean, I see some guys taking $500,000 right now in the commercial building portfolio, just because it's well, two things. They don't want to turn the claim in. It has to be substantially enough to where it warrants turning the claim in, because they don't want to take the risk of not having insurance forward. And then the other one is just hopefully offset some of their rate increases they've been experiencing for the last several years. So that's what's going on, and really it's nothing new. And to your point earlier in your intro, it's new to a lot of business owners. But I think at the end of the day, one way, Mike, I like to explain this to business owners, and very similar to the 401k, right? It's a deduction at the operating company level, no different than the 401k is, right? However, when you put it into the 831B plan, this stays tax deferred, provided you follow some rules and guidelines set forth by the IRS and within the tax code itself. As our role to play with our clients is we're like their 401k administrator. We're an 831B administrator. That's our core competency. We manage insurance companies. So the 831B has to look and feel like an insurance company first and foremost. So that's the box it has to fit in. And again, I don't want it to sound like a rocket ship by no means, but I do think the advantages it brings to business owners. I mean, we were around. I mean, we've been doing this since 2008. I got involved in this really because of the Great Recession. I saw business owners just keep doubling down every year, of the 172 accelerated depreciation, and just betting every year was going to be better than the previous year. And then because they were taking debt, right? I mean, that's the big tax plan. And I just thought this has got to be insane. And I was exposed to a couple gentlemen that had these plans in place. And those were the guys that were literally showing up their competitors' auctions, buying their equipment for 10 cents on the dollar. And I thought, okay, this is what smart money does, right? This is a way to manage risk, that not only your fortuitous risk, your things that happen by unexpected and all that, but it also manages the financial risk you take as a business owner every year. It's one of the things in the CPA community world where they all CPAs typically want to promote business. In the beginning, the business starts out, they do well, buy more equipment. The next one is buy a building. And then the next one is hopefully get a 401k going for your employees and those types of things. But that's kind of the playbook, a little bit of the things that they can offer. And the reality is a lot of people in business, they know how to run a business, but they don't necessarily need to own a building, because they're obviously, but there's not a perceived risk there, right? And I think there's a ton of perceived risk, a ton of risk in owning a building when that's not what you do. You build widgets, right? And now all of a sudden you own all these real estate properties. I see all that stuff all the time. So I kind of see the 831B playing out in a role where business owners, hopefully this will become a normal. And I really appreciate you being on your platform, Mike, because this is an education process, making awareness first and foremost. So really appreciate, and the fact that you're a CPA. We hope the CPAs will start to move more towards this, because it's not taxes aside, and the IRS doesn't like it and blah, blah, blah. It is a way for business owners to stay afloat when this may be their only lifeline. And I've been doing this long enough now, where I know the impact we've made for business owners around the country. And, COVID aside, we deal with a lot of other risk profiles. The complication of risk today in business is probably like no other. You look back in 1986, people were worried about traditional insurances. We were just starting in the age of information. So global economy was on its way. But fast forward almost 40 years now, I mean, the complexities of owning a business today when it comes to unfunded liabilities on your writ is substantial. And we deal with it all the time. Just dealing with third-party business interruption alone. When you're relying on the cloud and you don't have files anymore, you can't go to a file and pull out a paper file, when you can't use your computer, right? And now you've got it into a third party and they're compromised and you can't even get into your CRM system today. The amount of business interruptions that go on around the country is substantial. We deal with it almost every day.
Yeah, Van. So, kind of on that topic of some of the risks that businesses have, talk to me a little bit about what we would utilize a captive for. So is a captive something that's going to replace the policies I already have? Is a captive something that's going to create protection for me and maybe something that I can't even get from a current policy? I know you talked about covering some of our deductible. If we're taking a higher deductible, maybe we have a policy that helps cover some of that. Talk to us a little bit about what type of risks we typically want to insure within a captive. And also, you talked about being an administrator and how important it is to do these things the right way and how they can become under scrutiny. Talk a little bit about how you determine that risk and how you can back that up so that it is a true risk that's being insured and it's not overinflating something. Or, I know back in the day, you heard about businesses in Wisconsin opening up a captive and getting volcano insurance for a business in Wisconsin. Obviously, that's complete abuse of the system. But talk to us a little bit about what you guys do and the importance of having an actuary on the back end of that.
You bet. So one of the ways that we ask for the client's policies, first and foremost, I tell business owners, I'm not here to increase or decrease the risk you have. I'm here to position money to handle that risk more effectively. So I think traditional insurance companies do a really good job. They really do when it comes to traditional risk. And getting back to my point earlier, there's so many untraditional risks today. The merging risk out there today is so substantial differently. I mean, you look at supply chain risk, brand protection, dispute resolution, cyber, cyber policies are out there. However, there's a ton of exclusions on those and limitations to them. And then when you get into the third-party business interruption stuff that I just mentioned, those are known as enterprise risk management. Here's the one I would tell you that insurance companies do a really good job with the tangible assets of a business. So the building, the autos, things that they can get loans on, right? I think insurance companies do a good job with that. The intangible assets of the business is where they kind of fall down. And most business owners value the intangible assets. These are intellectual properties. These are your brand, your reputation in the community. This is your process and procedures, your cash flow, which is obviously huge. And that's a huge intangible asset of the business. And that's where we kind of fit in. So we'll underwrite, we'll dive into your policies. We'll look for limitations. We have a thing called a halo coverage. And what a halo coverage is it sits over and above your existing insurance policies. If you were to be denied or not have enough coverage, or you have a deductible, which is a first dollar loss, which means you got to pay out money before the insurance company kicks in, the halo comes in over the top and covers that. So think of that like an HSA plan now, right? Where, like a health savings account where, hey, I'll take on higher deductibles. I'll take on more responsibility on my health care insurance. For the benefit of doing that, I can open up a health savings account, fund that, and take a deduction on my taxes, right? So that's very similar to what we're doing here under the 831B. And I think that's one way to get business owners to really think in how this works. And actually, it's helped a lot with us educating congressional leaders as well on this code. And because we want this to become a normal business practice. Again, this ought to be just one more arrow in the quiver for CPAs to offer at certain levels of a business owner. As businesses succeed every year, as they get better and more profitable and more efficient and everything else, this ought to become one of the tools available to them as they mature as a business owner. And that's kind of where I would tell you that's kind of our clientele, are people that have been in business for a while, and they've done really well. And now they're looking at risk in a whole different light because, unfortunately, it's like everything else in life. As you mature, that's one thing you start to think about, right? I mean, as a business, you don't think about risk so much when you first start out, right? I mean, everything's going to be hunky dory and nothing's ever going to happen, right? I mean, you got to be positive outlook on everything. And I don't want risk to be a negative thought, but it is one of those things. Risk is like dealing with, I got to deal with my will. I got to do, it's that aspect of a negative perceived in business. However, positioned correctly, and again, to your point earlier, it can make all the difference in your business. And we hope, no different like the health savings account, you don't use it, and it just becomes another retirement vehicle for you as a business owner down the road. No different than the HSA. You can fund that HSA every year, and if you don't use it, you eventually get to convert it to a retirement plan. So that's kind of the way we're positioning this with business owners around the country to get them to understand. And I think HSAs were hugely impactful in trying to manage the rate increases healthcare has been doing for, well, I don't know, almost 2 decades now. Um,
Mm.
but at the same time, we're seeing a huge spike in traditional insurances, and we feel like that by doing something like an 831B, it alleviates a little bit of the pressure, not only the insurance companies are feeling, but also what the insured's feeling.
Yeah. So talk to us, explain it like we're talking to a first grader as an example. What is kind of the setup process? So we're opening up, is it a C corporation? Who's running that company? Who owns that company? Does that company have
Yeah.
employees, like actuaries on staff? Talk to us about kind of just the people at play and the money flow in a setup like this.
Yeah. You bet. So, okay, so we're the administrator, so we'll help you set up the to your point, it's a C corp. So the operating company that we'll be insuring for can own it, or the owners of the operating company can be shareholders of the C corp. So we don't get, we mimic the ownership of the operating company first and foremost. And the operating company is the operating company that this 831B plan, this insurance company, will be help supporting the risk on that operating company. So that's one thing. And we'll run them right through that gamut of that. We have a really good onboarding process with that. It's all automated. And I would tell you, that's one of our great assets of our companies is once the client says, hey, yeah, I want to do this, we run it through the process. And then we go through the underwriting. So we're going through the underwriting, and then we'll come back and we'll give them some numbers. I can just tell you on a top tier number, 10% of your gross revenue, but no more than 2% per policy. So if I got a guy that says, hey, I'm doing $5 million a year in revenue, I can afford to put half $500,000 away in this thing. We got to find at least 5 risks. Normally we're going to find, anywhere from 5 to 10 different types of risk that the business owner and honestly, it's about listening to the business owner. If they've been in business long enough, they've all had a nightmare story, unfortunately, to say, hey, this is what I'm losing sleep over. And so we'll wrap a policy around that. We'll do endorsements. And believe me, the more unique of a business you run, probably the more gaps and coverages you have, because insurance companies typically want to fit you in a box, whether you belong in that box or not. It's for the benefit of them, not necessarily benefiting you. And so that's really where we dive into the underwriting, and we uncover things. And what's an assumption by business owners, because I don't blame them. They don't read their insurance policies, and if you have insomnia, you want to read those things, you'll get knocked out right away. Those are like one of the worst things to read is an insurance policy. So that being said, that's what we do. We bring it to the forefront of the clients and say, hey, this is what we found. This is, you thought you had this, you don't have this, or hey, here's a limit of the policy, or here's an exclusion. I can tell you all sorts of exclusions now we're finding, especially with general contractors. I saw one exclusion. If you build more than 5 homes in any one subdivision, you don't have general liability coverage. And there's a lot of generals building more than 5 homes in a subdivision. It's just little, those things start to mean something, right? So those are things that we dive into. And from there, it's, we get the invoice to them. So we're going to come back with a premium. We'll always give the client the ceiling. Anything below that, we're perfectly good with. We'll put a higher value. Like if I got a company that's really dependent on a supply chain risk, they're really, they're dependent on foreign countries to deliver their product here. We may put more emphasis on a supply chain risk policy and in other different policies that are tied to that, more so than, let's say, cyber. So those are things where we kind of weigh out with the type of industries they're in. And then once we're up in that, and then we issue policies, we have a claims process. When the client has a claim, they can go online, they submit for a claim, we adjudicate the claim. Now, here's a couple things that business owners need to understand. Depending on the level and the size, most of our clients are pooled, which means they're going to share in other people's risk. Depending on the risk profile they have, right? So let's say brand protection, for example, right? You're worried about your brand. You have a good social media presence. You spent a lot of money getting there, and you've built that brand up, and now it's being attacked for whatever reason. And God knows we can go into those specific stories. We all know what's in the past, right? With business owners that have maybe caught doing something they weren't supposed to, and blah, blah, blah. So now it's hurting their brand. Um, anybody that potentially has a brand policy within our administration that we manage will share in a pro rata basis on their claims. And again, I don't want to get too much in detail on that, but I do think it's important to understand that this is not a risk-free adventure by no means. There is a calculated risk to doing these types of programs, and one of them absolutely is sharing in other people's potential risk when it comes to claims. Now, I will say on that front, Mike, that's just, you hope to God it's like every other thing. And when I buy an insurance policy, I hope to never have a claim. You don't want to have a claim. It's not a fun day. And I would tell you even more so when it comes to the things that we're looking to cover for business owners, it's a really bad day. And the fact that you can help other business owners on a small portion stay afloat when this is literally their only lifeline, I think it's not a bad thing from a business owner standpoint. I think risk takers help managing other risk takers risk. I think that's a good thing. And that's so, I've kind of changed my thought over the years about, clients, I don't want to pay other people's claims. Well, okay, I get that. But, just think about it. If it was you, if it happened to you. And then I've had these conversations every year now with business owners that, oh man, I was never going to have and then within the first year they have a claim and they're just thankful they have it. And so that's one aspect. I don't want to belay that any more than I need to, but I do want to make sure I drive that home with business owners that are listening to this, that there is some risk there and you need to understand that and you got to do your own due diligence. But here's the thing, you can't own 100% of your own risk and call yourself an insurance company. I mean, I think the IRS has made that pretty clear. And so I think for us, one of the things we have over our competitors is our distribution of risk. Our pools are significant. We have anywhere from 400 to 800 operating companies within pools. So when it does happen, it's based on a pro rata sharing. It's pretty darn manageable. And, that's and what I just literally described to you is insurance. This is how insurance companies operate. They leverage on the law of large numbers and we're doing that. And I think that's also kept us out of trouble with the IRS, quite honestly. So,
yeah. No, that makes sense. So 2 things I want to do before we wrap up here. First one is when, obviously with complexities, you're talking about the setup and there's a lot of different things that are going involved in that. There's a lot of things on the administrative side. So there's fees, there's costs, there's items related to that, which, people are listening to this and thinking, hey, I have a $200,000 business. Why don't I just put $5,000 into a policy like this? Obviously, the fees are going to eat into a lot of that. So talk to us a little bit about what size does this start to make sense from both a risk and a cost perspective?
No, it's a great question. And we get that. Yeah, it's the question, right? I would tell you that you want to be able to consistently be able to at least for $200,000 a year and off your balance sheets. And that's what I was talking about earlier about the maturity of a business, right? It's not easy to ask a client to take money off their balance sheets, put it away into a self-funded account, with the intent of, God forbid if they need it for a claim, right? So that's one thing. I would tell you, our numbers used to be lower than that a couple of years ago, but looking back at it, I think if a business owner can't do more than $200,000, especially in the first year, they're not ready for it yet. And I hope all of our clients get to that point, but to your point about the fees, right? So that's one thing. The other thing is, are they winning on that, right? I mean, if you're less than that, I think due to fees, I think you're almost just better off paying your own taxes at that point and being disciplined enough to save the money for things that are unexpected to you, right? So that's one thing. Again, this thing's not for everybody by no means, but we hope as business owners, as they become more successful, these are things that are going to come up, and as their tax liabilities increase, this is one of those things to mitigate the tax liability, but at the same time protect their company. And I think that's the takeaway, right? So
yeah, no, it's a win-win situation, right? Like best case scenario, you get a tax break. You don't need it. Things are going good. You don't need to put a claim in, but it is also a good safety net on that back end to say, hey, that we do have something available, in case something hits the fan. One question as we wrap up here, and this is kind of a loaded question, and we could talk probably for an hour on this topic. But people that hear about captives and they say, well, this sounds good. I like this idea. I like the risk opportunities, to help reduce my risk as well as the potential tax saving opportunities. And then they start to dig down the road of Googling captive insurance companies or micro captives. And they see a lot of fights against it from the IRS, where the IRS doesn't like these things, or they're, a listed transaction, or were a listed transaction at some point. So talk to us a little bit about the tax risk involved with having a captive. Kind of why is the IRS targeting these? What are they specifically looking at? And then what specifically do you guys do? Because I think this is really, really helped me when talking with you guys, is what do you guys do to help mitigate against any kind of tax risk that there might be?
Yeah, you bet. It's unfortunate, but it's like everything else, right? Tax codes get abused, and this code was abused, and it was abused for the purpose of estate tax planning. So that's one of the things that brought the attention from the IRS. Was really, it was not designed to be a risk management tool. It was really designed to mitigate estate taxes, and these are issues that are going on in the 2000s, right? Late 2000s, when estate taxes were so low, there was a lot of motivation. So when you look at the tax court cases that the IRS is, I'd say, cherry picked and actually gone to court with, there was really bad facts in them. They were done by estate tax attorneys that were promoting them, not risk managers like us. And there was alternative reasons to why they were going to do an 831B. And it really was to play into their estate tax planning. And so if you look at the Avrahambis that was the first case that was under the IRS by the 831B, I think that was back in 2017. And there's been several since, but all of them have been for alternative reasons than risk mitigation. So that's one thing I always want to drive home with clients. This is a risk management tool first and foremost. Treat it like that. I hope you get all the benefits on the back end. We don't know what that looks like down the road, but nevertheless, this is a risk management tool. So that's one thing. And I think that's what kind of helps us with the IRS as well. And then, like I said earlier about our pools, right? So that's one of the reasons why people have gotten in trouble. They've not pooled correctly. They haven't insured. They've insured for risks that's really they're not exposed to. And so those are just things where, people get cute with, and we avoid all that. We've gone through our 6,700 promoter audit. And it was open in 22 and it was shut down June of 24 with no changes. We were fully cooperating with the audit, the promoter audit. And like I said, we got our letter in June of 24. And they shut it down with no change. So, of course, they said don't read anything into that. But at the same time, they're never going to bless you. But they've had plenty of reasons to be upset with this program. But keep in mind, it's a law passed by Congress. Congress I would say both sides of the aisle. We've had to educate a lot of them. We belong to a really strong lobbyist group in D.C., and we're getting a lot of traction right now. I'm encouraged by some of the recent appointees of the IRS, quite honestly, that are aware of this 831B, because it's been on the books for almost 40 years. And a lot of the there's a couple congressional folks that, Senator Grassley, for example, he's the one that helped write the 831B tax code, and he's still in office. But most of these guys have changed, right? And so we've had gone through educating on that. But we do think it's going to come out. I do think the IRS is going to bring some clarity to it. There's some recent regulations that they set forth that we think was pretty aggressive. That was done in January. Literally, the previous IRS commissioner, Senator Jane Werfel, he literally they submitted the regulations, and the very next day he resigned. But we'll see where it all goes. But I would tell you this, Mike. I think it is going to become a normal business practice and live in the 401k. I mean, I think the die's been cast, and it's not because obviously there's tax advantages to it. Congress knows why they're creating an incentive for that, because they want these business owners to stay open. It's more important for them, if they're going to, maybe we don't create as much, all the tax out of those business, out of the profit of the business, but what are they doing? doing the payroll taxes, jobs, velocity of dollars, which, they get to tax over and over again, right? That's what business owners do. And it's the small business owners. I would tell you, small business to me, it has felt like we've been under attack since COVID, quite honestly. Maybe since '08. And this is a great tool for small to middle market business owners. I would tell you the big companies adopted to it first and foremost. They've been doing this kind of stuff for literally since the code's been in existence. It's unfortunate a lot of our business owners haven't heard about it. It's a lot of the entrepreneurs that we've dealt with over the years, first time hearing about it. Had they known about this back in '08, it would have made a huge difference for them. And so those are just things that are evolving, and I do see good things coming in the head of us that, awareness is going up. And I think due to the current insurance market, I think the IRS is just going to have to simply come out and give better guidelines, and not keep it such in a black box. And hopefully the CPA community will get behind it. The right CPAs that actually go in and do the tax planning and really sit down with their clients and really look at the risks that they're taking. And especially the more unique business they're in, they're probably taking on a lot more risk. And you want those guys to stay in business. And this is just one more tool to help with that.
Yeah, no, Van, this has been super helpful, and I think gives a really good overview of this mystic 831B or this captive concept that a lot of people either never heard of or, talk to their CPA, they initially wipe it off. So I just want to say thanks. Thanks for coming on. Thanks for kind of going into this. And I know that we're going to deep dive into this even further on a Tax Helm webinar later today. So I just want to say thanks for coming on. Really appreciate you sharing this. And just thanks for what you're doing for the industry and being willing to kind of get out there and help small business understand what's available to them out there.
No, I appreciate the opportunity, Mike. Really do.
So let's be honest, the tax code is filled with complexity, but hidden inside are powerful tools for those who know where to look. Today you learned how captive insurance and the 831B election aren't just for massive corporations. They're a strategic advantage for growth-minded businesses that want more control, more protection, and more tax efficiency. Big thanks to Van Carlson for making this topic not just understandable, but actionable. And if this sparks something, don't just file it away. Talk to your advisors, dig deeper, because the right strategy now could mean resilience when it matters most. Shoot us an email with ask@taxsavingspodcast.com and we can introduce you to our partner to learn more. Also, hit that like button, subscribe if you want more tax saving strategies like this, and don't forget to share with a friend and leave a review as it helps us keep doing what we do here. Remember, if you want to dig deeper into topics just like this, we cover all of this along with full implementation modules at Tax Helm. Check the link in the description below to book a free discovery call with our team. See you on the next one.